Yeah, I really view our conversation we're about to have to be an extension of what Axel just sort of teed up for us. So thank you, Axel. I think it was great. I think he laid out a nice course. I am here with Cory Reeder, Tyson Halsey, Eveline Gerck, and Mauro and Andriotto. Cory is a chief investment officer for an asset manager. We'll keep it at that for now. Cory will fill you in a little bit later. Tyson is managing member of Income Growth Advisors. Eveline Gerck is with the family office, and she does a lot of investing in venture capital. And Mauro and Andriotto is with SMC, a Swiss family office. So his insights into Europe, what's going on there, will be greatly appreciated, as well as his insights into blockchain, digital assets, and private equity and venture over in Europe. It'll be very insightful. So today we're talking about alternative alpha strategies. Marty stated, when he first broke into business, that meant you were profitable all the time. The goal was to be profitable all the time. Today, I think alpha alternative strategies, as we've discussed here in the past, is outperforming the benchmarks, not by a little bit, but by a significant amount. And usually those are actively managed strategies. And they usually identify market inefficiencies that allow for the alpha. But of course, as competition comes in and other things and market dynamics change, those strategies are not as long-lived. So the time span is limited. So market timing is a little bit more of an issue today. It's something you have to be on top of and looking for the next, looking at the market dynamics and determining where it's going. I think that's where AI was discussed, can be very, very helpful. My name is Mark Heil. I've been in alternatives since the mid-90s. In marketing, capital raising, fund administration. I'm getting into investment banking right now. So I've been around this business for a good while. And what's important to us today is, be clear that I think, we have to throw out the disclaimers. This is for educational purposes and not investment advice, especially those who are in the business. To the extent that I offer an opinion, it's my opinion alone. For the next hour or so, the panel and I are going to be discussing, actually, I think it's 50 minutes, alternative asset strategies. And we want you to participate in this. And Marty, I think a few weeks ago, we were in New York, I threw out a trivia question. Does anybody know who the Honorable Edward Everett is? Anybody? It's a history question. Okay, he was the person that spoke before Lincoln when he gave the Gettysburg Address. He went on for about 2 hours, and today nobody remembers what he said. My point in raising that and saying that is, I think if you're going to ask questions, keep it short and to the point. If our speakers need context, they'll ask you for it. So we want to avoid the 2-hour commentary and get to the actual point. With that, I'd like to really have everybody now introduce themselves. And Cory, we will start with you, given that you're 7'2" and the biggest guy in the room, so to speak.
Well, 7 feet tall, former pro basketball player, originally from Australia. But yeah, so I've been in the industry for 18 years as a fund manager. Came up through the broker-dealer world, and then 2017 stepped out into the independent arena. And then, currently we have a sort of an adjustment or a refocus. I'm still, sort of brains trust behind the fund models and stuff that are out there and offered through a different firm. But that our focus moving forward is really getting into the middle market arena and, private wealth solutions. We're looking to engage with a firm, a global firm based out of Zurich, Switzerland. We're just waiting to get the final data points and ink dried, so to speak, to make sure that we're not stepping on the wrong toes. So, moving forward, and that's sort of why, I'm not really putting a brand out there until we get that new entity established and formed, just to prevent any confusion or so forth in the future. I'm looking forward to this discussion. I'll leave it there.
Appreciate that, Cory. Tyson, why don't you go next? Give us a quick background and talk a little bit about your firm.
Tyson Halsey. I'm a investment advisor in South Carolina. I also have a startup called Optima Process Systems, where we look at process technology and apply it in the energy space. We're big proponents of what we think is a major rotation, and I'll talk more about that later. But that is, we've had a great period in terms of stocks for 40 years while interest rates have declined, and now interest rates are going up. We have inflation that's out of control, and this reminds us a lot of the 1970s and the period from about 1999 to 2011 when commodities did unusually well.
Fantastic. Thank you, Tyson. Mauro, would you please take a minute and welcome us from Europe here and grace us with your presence and background?
You're on mute, Mauro. Mauro, unmute.
Sorry. Thank you. Thank you very much, Mark. My name is Mauro Andriotto. I'm an adjunct professor in finance in Italy and Switzerland. I work with the Swiss government as an advisor of the Federal Agency for Investment in Innovation. So I help the Swiss government in the venture capital business to select small, medium enterprises that could be interesting investment for new innovation. I am part of the SMC family office, where I work most of all in private equity deals. And I am also into blockchain industry. I'm a board member of the Swiss Chamber of Commerce, together with the former president of the Swiss SMA. My background clearly is a financial one. I'm the former quantitative leader for Ernst & Young for the South Europe. And as you already know, I'm based in Switzerland, so I will be happy to give you a European view on the economy here.
Fantastic. And I think we'll get to that right after Tyson takes us through a short presentation. But before we get there, I want to go to Eveline, give her a chance to introduce herself. You're on mute too, Eveline.
All right.
There you go.
So great to be here. So my background, I started investment banking. That was interesting that I talk about. I heard Alex talking about gold mining. That's how I started. My career was a mining equity analyst, and then moved to manufacturing, and then moved to private equity. Today, I'm on the board of 2 venture capital funds and 1 long equity fund, and also a nonprofit healthcare. I'm also going to be, coming with the news of a board that's exactly in clean tech energy and some mining interests. And so in that capacity, I have worked with family offices like Alpha Square and helping them to select investments and investing funds. And I'm happy to be here and talk about alternative strategies today.
Well, fantastic. Thank you, Eveline. Tyson, I'm going to let you lead off. And if you walk us through those couple of slides that you have, that'd be greatly appreciated. And then we'll pick up the conversation after that.
Okay. Do you all see that IGA soft landing with a question mark?
We do.
Okay, so I'm going to do this in 5 minutes. It's 8 slides, but sometimes a picture's worth 1,000 words. The consensus in terms of the stock market right now is that we're going to have a soft landing. And everyone was getting a lot of background noise. You hearing that?
I think Mauro must be on.
Okay.
Yeah,
so we have a consensus that says, oh, we'll have a soft landing. This is great. And the Fed did all right. Well, the Fed, I think, has done terribly, as has the Treasury. And what I'm going to talk about today is a couple issues. One is Fitch downgraded our debt, and Janet Yellen, running the Treasury, said, this is totally undeserved. I think it is totally deserved. I think that the finances handled by the Treasury and the Fed over the last decade and a half have really been a huge disappointment, and now we may have to pay the piper, so to speak. I think one of the things, without a doubt, is over the last 15 years, we've had abnormally low interest rates, and abnormally low interest rates have led to overvaluations in stocks, bonds, and real estate. And now that interest rates are higher, I think that you, in aggregate, over the next several years, have a headwind for stocks, bonds, and real estate. And what I'm going to talk about in particular is that the risk premium is now starting to decline and really suggests that stocks aren't the place to be anymore relative to bonds, and that the CRB looks like it could be breaking out. And if we get higher bond yield, if we get higher oil prices, I think that you're going to see higher inflation and the CRB will go up. Again, a little background noise. I'm not sure who that is. But quoting Janet Yellen, Fitch's decision is puzzling in light of the economic strength we have seen in the United States. And I strongly disagree with Fitch's decision, and I believe it is entirely unwarranted. I'm just a normal guy, but when I think that what she is saying is so fundamentally wrong, and she's perhaps the most important banker in the world, it scares me. And here's where I see a problem. Below, I have a chart of the interest that is paid on the federal debt, and that is shown from 1990 to 2003 currently. And since 2020, it's gone from about 500 billion a year to almost $1 trillion. So it's a doubling in the last 3 years. It was kind of flat here after the great financial crisis. It grew while our debt grew. And here's a chart of the federal debt, the aggregate, which we know is about 33 trillion. And one of the things is the discussion about the deficit isn't something we've heard about for a long, long time. And for a while, because of what the Fed was doing in terms of buying US treasuries, they depressed interest rates. And so we weren't getting the growth in the debt service that we see here running up parabolically. Excuse me. So here's the Fed model. The Fed model shows the risk premium. Again, we got some background noise. But what it does is it compares the earnings yield on the S&P 500, which is at about 5%, and it compares it to the 10-year U.S. Treasury. And right now, the 10-year U.S. Treasury is yielding about 4.50, and it's moving higher. And once the treasuries yield more than equities, that usually is a sell signal. It's what tipped over the market in 1987 and also led to the great bubble in 2000. Another place where I see some risk here is that the Magnificent Seven, all the large cap growth, which are huge beneficiaries of lower interest rates, that to me, it looks like it's gone parabolic. You've got a double top and you're ready to roll over. But I would not be surprised if, like other bubbles we've seen in the past, the Nifty 50 in the 70s, all the tech titans back in 2000, that we see underperformance for a decade in some of these. And maybe they don't collapse, but they go down 30%. And but basically, I think that play is over. One of the areas that I think could be a problem is the commodity space. Commodities add to inflation. Oil and energy pulse throughout the economy. And if oil prices go higher, let's say JP Morgan last week was saying they could see 150 in terms of oil. We start seeing that in gas prices, and we will. That will be highly inflationary, and it's going to force the Fed to continue to tighten. And Robert Shiller got a Nobel Prize. He came up with the CAPE ratio. It's a nice long-term way of evaluating markets. And the CAPE market, the CAPE ratio tells us that the S&P 500 on a 10-year basis has a multiple of 30 times. And it is well overvalued over the last 140 years. And one of the reasons it's been overvalued and they've been able to justify it is since 1981, we've had declining rates until 2020. Now those rates are going higher, And I'm saying they could go even higher. I think Fed funds could be at 6.5%, and there's no reason you couldn't see 6% 10-year treasuries. I don't want to see it, but that will definitely cause some real pain. It would definitely feel like the 1970s. That's one of the risks. And here is basically what we're looking at. I think the Fed got into a lot of trouble in the second half of the 1970s when they had some success bringing down inflation, and they started easing too soon. I think sort of they're celebrating the success of a soft landing, and Wall Street's looking for lower interest rates in the future. But the fact of the matter is they have not resolved the inflation problem. And I would say that that's because they're approaching it the wrong way. This is really a supply issue. They need to produce more energy and resolve supply issues, not tighten interest rates. But nevertheless, if we start to see what we saw in the second half of the 70s, interest rates during that period went from 7.5% to 15.8 from 1975 to 82. Those were miserable, miserable times. Anyway, I'm Tyson Halsey, and if you have any questions, fire away.
I have one question.
Go ahead.
So I pretty much agree with everything you said. And one of the things I found is that if you pretty much everybody thinks 30-year treasuries will be 4.5%, but Bill Ackman, probably the only guy in the world that thinks, well, I would include myself in that those 30 years will go up to 5.5%.
Well, I agree with
so
that.
I'm short TLTs. But the other thing in short-term rates, the other day we had the Citibank guy, Jamie Dimon, say, 5.5% on the short term, the Fed funds rate could go to 7%. He says it's not my base case, but it's not unlikely. So finally,
and I say
many
that, I
years
agree
people
with
are
that.
breaking with much higher numbers.
I'm sorry, what was the question?
I'm saying the question is, for a long time, everybody had sort of suppressed the fact that this is it's happy times are here again. But finally, you're getting a few outliers saying things that you're saying, this is a much worse problem than people have perceived.
Exactly. And here's where the problem is. The fact of the matter is, we don't know what the future will say, but we do get bits of news on the margin incrementally, week by week, month by month. And what we've started to see is that inflation numbers, CPI numbers have stopped dropping. They've started to go up. And lo and behold, if we start seeing commodity prices go higher, then I think we got a real problem. We don't know where the economy is going to be. And if it reaccelerates and we have not put this inflationary problem to bed, and everyone's talking about the inflation getting back to 2%, I doubted whether the Fed would be able to do that. I think that it's fundamentally illogical. The way you lower prices, you increase supply. They're not focused on supply solutions. They'll regulate this, or we'll put money in here, or now we'll just raise rates and it'll slow buying. Those are not that's a monetary solution to a fiscal problem. So yeah, I think that we should watch and we will see where things go. But I think that the Fed is hoping and praying inflation drops. But if we get higher energy prices, that is really going to be a problem for us going forward. And I think that what I'm saying is we're at an inflection point. Everyone was saying 2 months ago, 3 months ago, yeah, we're going to get a soft landing. Inflation is going to come down to 2%. I think that perspicacious observers are saying that very much is at risk, which is my.
Yeah, I think I'm hearing that too. I'm getting, I'm hearing a lot like 8.5% mortgages in the very near future. Marty, fire away with your question.
Yeah, it's just a quick question, Tyson. So one of the problems with economic measurement is that or financial markets is that it doesn't really measure quality of life. But there's an issue, right now, what I call the vintages of economic cycles, which we have this past vintage with very low interest rates, and a lot of people are locked into that. Look at the mortgage market, things like that. And then you have like commercial real estate where all these loans are expiring. into the future, et cetera. So you've got this vintage of ultra new business that has to be done at higher interest rates, which is going to call into question a lot of efficiencies that most people don't have in operation. So, you know, what does that look like when you've got this bifurcated marketplace of an old vintage of you know, of investment versus a new vintage, which calls for incredible efficiencies? You know, like how do you get velocity? Like I think most of the market is about the velocity of money, right? How do you get velocity out of high interest rate economics, Tyson?
I don't know how you get velocity out of it. I think what you need to see, is more production and you know, less regulation. I think that the idea that we're going to get all these green metals, but we're not going to allow any of these mines to be built in North America is a problem. And I think if you keep on shutting down oil and oil prices keep on going higher, you're going to get more inflation. I'm
just going to ask you about your thoughts on the role of energy and all that also.
Say that again?
I was going to ask about your thoughts on the role of energy.
I think energy goes higher. I think that bottom line is we have underinvested in brown infrastructure and green energy infrastructure over the last several years. And we need more energy to grow this world. You know, we're not keeping up with the population, and people want to live better lives, and you need energy to do it.
Cory, I want to ask you, you know, you've heard Tyson's background, you heard what he's speaking. Put on your CIO hat now and tell us, how do you look at it? How do you invest in this type of scenario?
Well, and to follow on from Tyson, you got to also remember that our current person in the White House has drained the SPR, our Special Petroleum Reserve, down to basically empty. So we have no buffer, no cushion for energy spikes and problems that go on, let alone the domestic production that's been, you know, destroyed or cut back on, or, you know, everything that Tyson was already talking to. But you know, there are so many things going on out there, and record levels of things occurring. You know, talking about the velocity of money, you know, the M2, I believe it was the M2, the level that it has hit recently, the last time it hit these levels was leading into the 1930s depression. You know, history never repeats, but it does often rhyme. Every single time the Fed has gone on a rate hiking cycle, it's led to a drop, a crash, or a crisis, including recessions and depressions. So, and here we are, we've gone on the most egregious rate hiking cycle in many a year. And this is coming, as Tyson mentioned, this is coming off a period of 13 to 15 years where we've effectively been living on life support of 0% interest rates here in the US, negative interest rates in Europe, and by the ridiculous amount of bond buying, and then by policy decree in Japan. And now rates have taken off to the moon. So there's still the lag effect. There's still all the knock-on effects that have still yet to be felt. So, I mean, as far as, you know, I guess coming back around to the topic at hand, alpha strategies. I mean, alpha, a very cursory or basic definition, is looking for additional outperformance in returns as compared to a benchmark or so you know, you have different alternative strategies that, you know, alternative can be listed across so many different areas and facets: venture capital, you know, real estate, commodities, precious metals, rare earths. There's, you know, distressed debt. There's all sorts of different areas that are outside the regular world of just regular stocks and bonds with the stock market. The way I view, you know, alpha and alternative strategies is, you know, as opposed to the Wall Street approach of buy and hold, stay invested at all times. Why? Because over the last 120 years, stocks have done one thing, gone bottom left to top right, and you've got, what, an average of about 8% return per year over that time. Well, that's wonderful. But how many investors have 120 years to attain that 8% return? Because markets do go up and down. And so when you're looking at real timeframes of people's experience in the market, are you buying in at a low and experiencing the upcycle, or are you getting in at the top when you start investing and catching the other side of it? So with what we do, it's not about what you make. It's about what you keep. And so with the strategy that we employ, it is about capturing the upside in markets, but then to the other side, avoiding the downside and the losses. So, think about someone mentioned TLT, they're heavily shorting TLT. And so I'm sure that person is very well aware that since the end of 21, TLT is down 50%, the capital price of the ETF that he's using. And so, I'll give you a real brief glimpse. Come on.
Yeah, we're seeing you share your screen.
There we go. All right. So,
well, it says
we're not seeing it yet.
We're seeing black.
There we go. Now we're in.
All right. So, here's our total return income fund. It's a conservative model, half stocks, half bonds. But you'll notice from the end of 21, if you have 50% of your portfolio in bonds and you have a 50% decline, that would be a 25% hit to the performance. However, we didn't have that problem because we were not invested in that arena as those prices were going down. So, head to head, our conservative fund is beating the equal weight markets by, and this is as of June, as a couple of days away from the end of September, we'll have the new, see where numbers are. But, go to our US equity fund, head to head, 100% US stocks against 100% US equity market. That's a 20% beat head to head because we didn't drop in 2018. We didn't crash in March of 2020. We didn't lose when the markets went down. All the markets tended to do was catch back up to where we already were. So that's, with how we approach things. Let me get out of this screen share. Come back to Zoom. Marty,
so the alpha strategy is to avoid the losses.
Yeah, that's it. And that's how you provide, and just speaking of those Fed rate hikes, you can look, each one of these red lines was the corresponding crisis that was effectuated as a result of each one of the rate hiking cycles that the Fed has done, going all the way back to, this chart shows 1962.
Well, I think we've discussed this before, but the corollary, there's an adage, the path to hell is paved with good intentions. There's a corollary to that, which is the path to bankruptcy is paved by market timing, right?
Well, and there's market timing. That's where people say, I think that the market's going to do X, and so I'll do this now to avoid whatever that X result's going to be. And then, of course, the market does the exact opposite thing. With what we do, we don't time the market times us. We have an underlying approach that reacts to movements and strategic targets within the markets. And then, so we're reacting to the market as opposed to trying to predict what the market's going to do. But I guess to wrap it all up, what's the definition of a pessimist? It's an optimist that's been smacked in the face with reality.
Touche. Well done. Eveline,
I think, as far as moving forward, I will just say that to Tyson's points, I think commodities is a big positive arena to be looking at for outperformance. Precious metals, I'm a huge bull in that arena as well. And then in the international space, obviously emerging markets and the Asia Pacific region are heavily undervalued compared to the European and developed arenas. But when the markets go bidless and correlations go to 1, it doesn't matter what area you're invested in, everything drops at the same time, and we've all seen that happen time and time again. So it's always about what time frame you're talking about. Anyway,
I'm sorry, where did you put the pin on the map? You said the specific market area. You weren't too specific with the area.
Within the international markets, more interested in the emerging markets and Asia Pacific regions.
Asia. I'm sorry. I thought you said. Okay, I misunderstood what you said. Asia Pacific. Okay, now I got it. Thank you. All right, Eveline, I'm coming your way. I want to chat about the private markets and what's going on there. And Mauro, I certainly want to include you in this discussion as well as the European viewpoint. So, Eveline, why don't you talk about what you're seeing in the private markets right now, where you think the opportunities are? And I also know you have an opinion that maybe is a little different than Tyson's and Cory's. So if you want to share that, feel free to do that as well.
Yeah. So it has so many points that the panelists have addressed, starting with the previous one, Alex. So I think that we have two major changes in the world right now. The first one is the energy matrix. And that is happening because of climate change, because of new discoveries. And in Europe has happened much earlier than it is starting to happen in the US right now. We're really behind Europe. And then you have the other change is AI, which is the ball at the moment. Every business has to say has AI. Everybody's trying to put AI in the composition of new ventures. If you don't have AI, you don't get funded. But as Alex was saying, AI started like many years ago. And if you look at the, change in the energy matrix, it just started like really 20 years ago. So I was looking at the Industrial Revolution, and it started, in the early 1800s, even before that, and it took 70 years. So if you really look at the spectrum, we have 10 years, maybe or 20 years in both the change of the energy matrix and AI. So having said that, I'm not as pessimistic because I believe that different from the Industrial Revolution, it might not take 70 years for all these technologies to kick in, both AI and energy. Now, and alternative energy, right? Because the difficulty here is emerging markets to evolve to energy and to a green energy. They're going to be like slaves of, oil for many, many years still, because it takes longer to get to those markets. So having said that, we're talking about going after alpha in this environment. And, as Cory said, alternative can be many things. You can invest in farms, you can invest in private credit, you can invest in cars. I mean, you have invest in wine, all this is considered alternatives. And you have venture capital and private equity. So eventually, if you look at family offices and if you look at individuals, they really want to preserve capital. So we keep saying like, you can buy this, startup is a unicorn and you're going to have like 500%, but that's not, most of the universe is chasing. So when you listen to somebody like Warren Buffett, he says, look, just buy the S&P 500, stay there for 20, 30 years, you won't lose money. Again, maybe you're making, like Cory said, like 8%. And so you need to have an alternative strategy that preserves the capital, and you can beat, the S&P or Russell or the traditional, indices. So I want to share two funds that I am on the board that achieve that. And I just have a few slides here just to go quickly over that. So the first one is a venture capital fund. So this fund only invests money for families and individuals. Why? Because it's not chasing like the 100%, right? So in the past three funds, it has been in the range of, 20%, so 16, 22, and we are in fund 3, which is around 22 again. And if you look at the life of the fund, it's beating the S&P in the past, less than 10 years, 8 years. And then, so the trick is, is this fund chasing? It's chasing everything that makes life easier and is transformative. So we are in SpaceX. Alpha is a prop tech, but it does have AI. So it's a mix of investments that they're all technology related and they're all like late stage. So the reason I stress the late stage is that for you to keep, protect the capital and have the return that is above 20%, you need to have like later stage venture capital. And that's what this fund does. I just had an exit lately, Hero, that was 7 times the money. And if you guys have interest in, talking with the people in this fund. You can talk to Gary, who is the fund manager. Simone is the investor relations. I'm just on the board. But that's an alternative strategy that is safe and protect your capital, and you have the return. Then I have another fund that
Eveline,
is
quick
totally
question.
different.
Eveline,
Yes.
quick question. Is that Gary Post who used to work for a family office down in Newport Beach?
Exactly, Andima. And Andima is one of the biggest investors in the K funds, by the way.
Yep. Okay. So Gary and I go back 20 years, and we have we're actually on the executive committee of Working Nation together. So fantastic, great.
Yeah, so that's the guy, ex-McKinsey. Then we have something totally different. And that's, this fund. So what this fund is this kid got the money from his family, the various family. And for 7 years, he has been investing. Here's the black line here, right? So always the black is the fund. So what he did 3 years down the road, 4 years ago, some friend said, why don't you have a fund and you put some of our money? So he did it a little more protective. But if you look, in the past 7 years for the money his family gave to him, he has 139% return. And if you go into the fund, the 4 years, so he didn't want to have, investors from the outside until he could have a history of return. And he beats every index, S&P and Russell and the hedge fund indexes as well. So what is interesting about this proposition is that it is like the performance. If you look like his performance right now, again, he always beating every index like by, twice. And since inception, instead of 39%, his return is 75%, which is incredible. Now,
Eveline, there's something wrong with this screen that you're showing.
Yeah.
It's all broken up. Yeah.
Is it?
Yeah, I don't think there's anything she can do. I just think it's a bandwidth issue.
Okay, yeah, it's shadowy.
So hold on, let me try again. And I can just talk about it without the graphs. But so let me go to.
This page shows up fine.
How is that? Is that bad? Is that
That's
good?
better. Yep.
Much better.
Right.
Yeah.
So this is the fund, which is the black line against every possible competitor. So why is this an interesting proposition and why I like that? This is public equities, all right? So we have a study from the Dow Jones, the New York Times just had an article about that no mutual fund, no hedge fund in a period of 20 years has beaten the S&P 500. I mean, that's idiotic. Why are you going to put money in a mutual fund if you cannot beat the S&P? I just buy the S&P. The only way for you to beat the S&P in public equities if you have a concentrated portfolio. So for you to have a concentrated portfolio, you're going to have like between 5 and 12 stocks. How are you going to pick the right stocks that over 5-7 years are going to give you 139% return? So that's what I like about this kid, because he worked for Google, he worked for PayPal, so he knows technology deeply, and that's all he does. He only picks 6 to 7 stocks that he knows everything that's going to happen with this company from being really close to the company. So right there, I think this is an alternative strategy because you're in a concentrated portfolio that protects your wealth. You are in public markets, you're beating every index. So if you have interest in this fund, you can reach out to me and I can connect you to the fund manager. So make a long story short, I think that the world has a lot of changes going on, but if you have the right fund manager that directs you to the right investments, you can really, you don't need to go crazy and go into like crazy unicorns, even though I also am in a seed stage fund that has unicorns. But we talk about family offices. We want to protect your capital, right? And still make money. So that's what I think is a good alternative alpha strategy for family offices.
Fantastic. Mauro, you want to pick up and give your thoughts here? What are some things that you're looking at? What are you investing in? What's the view from Europe?
So, as regarding my consultant business, as I said at the beginning, I'm helping the Swiss government to select venture capital opportunity in the seed stage. So we are not really investing directly, except some co-investing that we are doing is some opportunities, clearly in a fintech related to the new technologies, and I would say clearly first blockchain, where we are also actually involved directly in a project in Switzerland with a platform that is tokenizing and digitizing financial securities using the blockchain. So it's a very similar platform to the Swiss stock exchange, but with a semi-decentralized model. And it's one of the first platforms in Switzerland that is offering a primary market and a secondary market for the trading of the security token. We have already done also several deals on the platform. The last one is the digitization of one of our projects that would have been done as a private equity traditional project, but we have decided to digitize the shares of that one. Is a real estate in the north west of Italy, in Courmayeur, close to Chamonix. We have collected almost 4 million with security tokens that actually are representing directly the shares of the company that will build and implement the project. On the other side, see clearly a lot of movement with artificial intelligence, but we do not have any direct investment there. Biggest deals on my desk right now are in the private equity, where we are directly involved. Most of them, I would say, in the real estate, but in the luxury segment, because clearly in that segment we have less less correlation, let's say, less negative correlation with the interest rate. So we are able to sell apartments and real estate opportunities to high net worth individuals that clearly do not need to get a mortgage to buy the properties. And we have a couple of projects. One, as I said, is the one that we have tokenized, and we have another one in Cortina d'Ampezzo that is in the west of Italy, where there will be the Olympic Games in 3 years. The other deal that we have that we believe it's not one, at least for Europe, it's in the HVAC sector, so heating, ventilation, and air conditioning. We are doing an M&A deal there. We are acquiring 3 companies in the north east of Italy. It's a pretty not a topic because we have a new directive from the European Commission wherein there is a limit that is 2030 properties must be energy efficient. So clearly there will be, we believe that there will be quite a lot of money, quite a lot of public money that will be put in this sector to help people in Europe to restructure their properties. And this already happened, in particular, like in Italy, in the previous 4 years with a measure that was called a super bonus that was giving up to 110% of the restructuring cost as a fiscal credit to people that were clearly transforming the building in improving the efficiency, the energetic efficiency of the building. So we believe that in the next 10 years, this will be quite a hot topic here in Europe.
Yeah, it seems like there's been a lot in the real estate area around making buildings more efficient, making them more energy efficient. I've seen a lot of interesting ones, including glass that can then power the building and power all the lighting and everything that needs to take place there. So I agree. I think people are looking towards those types of innovations to help make good investments and get good returns. And it's filling a need in the space.
So let me say just one thing, that consider that in Italy is foreseen in the next 10 years that 8 billions of buildings will have to be renovated in order to meet the climate change directive of the European Commission, because otherwise the penalty would be that you would not be able to sell your property if it is not energy efficient. So after 2030, there would be this limitation, this penalty that you would have to support if you do not have an energy efficient building.
Fantastic. So one of the things you were speaking about a little bit earlier was the whole crypto world. I wanted to just delve in a little bit more and involve Cory and Tyson and Eveline in this about what you see going on right now. You know, a number of institutions, BlackRock's coming out with an ETF. Franklin Templeton just filed for one. Fidelity predicts a $1 billion Bitcoin by 2038. Seems like a lot of momentum is going that direction, but at the same time, the asset, you know, the crypto itself is floundering at, you know, $26,000, $27,000 right now, and people are predicting it to go down before it goes up. So what is your take on what's happening in the whole crypto digital world? And Cory or Mauro, if either one of you want to comment on that.
Well, my view is that crypto is still like, it's like the Western world. I think that crypto is like emerging markets 20 years ago. You're going to have so much ups and downs, and everybody's getting in, and because, you know, this is a change that's going to happen. But with AI coming into play so more aggressively, I don't know what this is going to be also impact the crypto market. So it has a lot of things still to change. I think what I see is a lot of volatility.
Well, you
Yeah,
know,
for
crypto's
sure.
really been trading as just another liquidity asset. As liquidity's been getting drained out of the system, then, you know, there really hasn't been any or much of an upward inflection in crypto as a whole. So, you know, when the next well, here's the question now. We're in this world of uncontrolled inflation already, and so, you know, we get into it, you know, the economic brakes really start to get slammed on, and the Fed's knee-jerk response has always been to print more money out of thin air ad infinitum, you know, more gagillion, fulfilling, jajillion Dr. Evil dollars, which has led to the inflation that's already there. So what happens when we get into that next downturn, and, you know, do they stop printing ad nauseum again, which just creates more inflation problems, which then of course will be more liquidity for all sorts of asset prices across the board? Or do they need to, you know, continue to maintain focus on trying to tamp down inflation? And as much as crypto is and has been held out as the alternative to the fiat currency systems out there, you know, it has been trading more as a liquidity asset as opposed to a other option asset that it's always been held to be. But I think, you know, longer term, I think Bitcoin and Ethereum, I mean, at least those are the two that I follow. There's 1,000,001 coins and tokens out there to choose from. Some of them are, you know, Dogecoin. I mean, that was created as a joke compared to, you know, of Bitcoin, I believe, and yet it's still out there trading. So I think there's a lot of dead ends and empty roads within the crypto space, but I think for the stalwarts and the mainstays that you know, longer term, I think that there's upward, you know, price mobility for you know, the grandfathers of the industry.
Mauro?
Just two quick points. The first one is that from a macroeconomic point of view, the asset that was promising to be inflation proof maybe might have broken this promise, because we see that Bitcoin is minus 50% more or less to what was a couple of years ago. Now everybody is waiting for 2024 speaking and hoping about Bitcoin reaching 100K. But the real problem that I see is that Bitcoin has been pushed, as many other assets, by the amount of liquidity in circulation, and its correlation with the stock market has increased dramatically. Bitcoin and other cryptos as an alternative to fiat. On this perspective, I believe that there is quite still a lot of resistance from the traditional world. There are still many banks, even in Switzerland, that is one of the most friendly countries with cryptocurrencies, that do not want even hear anything about cryptocurrencies. So the conversion between cryptocurrencies and fiat is still not very easy, and you need to use exchange. Then later on are giving problem when you are trying to transfer the money in a traditional bank.
I just want to jump in here, and we have about 2 more minutes, but how many people in this room have owned crypto? 1, 2, 3, probably 30%. How many have made money in crypto? Lost money on crypto? Yeah, thank you. I think more people have lost money on crypto than have made money on crypto. But I'm a big believer in Bitcoin, although I don't know about the long-term impact. I mean, I'm a long-term believer in Bitcoin. I'm not a short-term believer in Bitcoin. But I have no belief in Ethereum at all, or most crypto, because it's just tech. And blockchain tech is just like every other tech. The value goes to zero. It becomes part of infrastructure. It's assumed. And everybody just assumes it's there. So I don't know. That goes against the whole ethos of what venture capitalists have said to our group for 20 years, which is that once something's assumed, it no longer has value to sell. Yep.
I have a thought on this, and that's the reason I did invest in crypto after studying it for a very long time. It needs more regulation, and the more regulated it gets, the closer it gets to fiat.
Yeah, so my perspective on crypto is I don't want to invest in it until all the litigation's over. Right? There's absolutely no guidelines, and the FTX thing was a disaster, and the fact that nobody was watching it, I mean, it's amazing, right? How could this thing be out there for as many years as it's been out there, and nobody's watching it? It's incredible. I mean, the VCs weren't watching it. I mean, we've had 80% of the old guard crypto guys have presented to us, and we've had more than 100 people invested in different crypto funds from our group, and a couple of people did invest in FTX, but FTX never came to us because our group really scrutinizes people. They never came to us once. And then I was asking a year ago, I was asking how they were buying everybody up when they were selling on secondaries themselves for 50% off. I don't know if you've come from a banking or finance background, that's mysterious, right? You're at a 50% discount. I mean, you're like the person with one eye leading the group of blind people. I just don't get it. Anyway, so can you guys give closing statements and then we can move on? I think it's been really great presentations. So Cory.
So maybe just finishing off on the whole, fiat currency alternatives. Obviously, you have your real tangible assets in the commodities arena, but let's not forget about the BRICS Plus anti-SWIFT system that they're now getting established in this multipolar world we're moving into, and you've got the US dollar backed by the full faith and credit and $33 trillion of US debt. Or now you have all these BRICS companies that have been buying up massive amounts of gold. And so hence, will they lead to at some point a gold back of some form or summary to their alternative system? And then that would that provide more security as opposed to the US dollar and a move of more assets and countries of trade away from the US dollar down the road? But of course, that's a topic for a whole nother conversation.
Cory, there's actually a philosophical question, and before I got my MBA in finance, I went to an Ivy League school, which would required you take classes in the arts, and the philosophical question is, when you've got computational ability to be highly decentralized, why do you need a centralized bank, right? So historically, before 1913, every state issued their own currency, was backed by gold or silver, right? And sure, there were blowups, but at the time, the United States became the largest economy in the world without any central bank. And some people are old enough to remember. Gary, you remember that, right? When that happened? Just joking. My mother's
Well,
like,
the
come on,
US used to be on the gold standard until what, 1971, when Nixon took us office, and then did you see what happened to the nation's debt after we were disconnected from a
So what I'm saying is that there's no reason to have this massive financial system on top of people's economic transactions, right?
Remember
maybe
too,
that's
the
not
central
the
banks
correct
are a group of-
catechism or whatever people teach, right? But anyway.
Well, I was going to ask Cory just a quick question about that as people do the wrap up. Cory, they were supposed to come out in August with that. They didn't do it. What's your read on, is that because they don't have enough momentum among the nation states, things like that?
Well, I mean, they added on, I think they added 6 more countries to their BRICS organization. There's like another, I don't know, 13 or 19 countries that are already on the waiting list wanting to join. So maybe they're just waiting until they hit critical mass and they get enough, interconnected contracts, bilateral trade agreements and everything else. And once they sort of shore up the foundation of what they're looking to do, then they, down the road, they could possibly come out. But just pay attention to what all these other countries are doing with central banks around the world have been massive buyers of gold. So that doesn't happen by chance. There's something that's going to come as a result of that.
Something more meaningful for people to think about is what's going on in Africa right now, where Gaddafi was going to launch a gold-backed African currency, and France would dwarf him because of it. And now there's a counter-revolution because Gaddafi lost, of 7 of 15 African franc countries rebelling against France, and France has pulled out of all of them. So they will ultimately go to a currency that's backed by some kind of commodities, right? I think Nigeria, Republic of Congo, they have huge mineral rights, and I think Nigeria is the leading exporter of uranium to France, right? So there's no reason you can't have like a uranium-backed currency or something like that. But we can ponder that later. Anyway, Tyson.
Yeah, I'd like to say the following. Since 1982, we've seen a 40-year decline in interest rates, with the 10-year U.S. Treasury getting down to 0.5% in 2020. It's now at 4.5%. I think during that period, from an investment management standpoint, the idea of 60% stocks, 40% bonds was a great place to be for retirement plans in terms of risk-adjusted returns. I think that we're now in an inflationary environment. You want to be 25% in cash or cash equivalents. That could be a 2-year U.S. Treasury yielding 5%, 25% in commodities. That could be precious metals, green metals, mining, uranium, 25% in stocks, and 25% in bonds. I think we're in an entirely different environment. Things that have been popular will not be popular going forward. I think you want to buy small cap. I think you want to buy value. I think the emerging markets. I think the idea is you want to buy what's been beaten up, and where there's value in cash generating investments.
Hey Tyson, if you have a one-pager or some kind of a document you can circulate with the group, send it to me, and I'll make sure it's on the follow-up email. Thanks.
Sure.
Okay, Eveline.
Hi.
Yeah, you have a closing statement?
Go ahead.
Me closing statement? Well, I think that I made that comment when we were preparing for the panel. 2 years ago, I spoke in San Diego in that Marcus Evans conference, and everybody was saying that the war in Ukraine was going to be short and that we were going to have a recession. So 2 years later, everybody's still waiting for this recession. And inflation has come down. I agree with the stagflation.
Money is expensive.
Resistant. But I think that
very expensive
I don't
in
see
this
a
market
recession
right now.
happening.
You have amazing traction.
Hey, I'm sorry, I don't know who's talking, but if you can read
It looks like Julia Valentine.
I think that's the closing statement.
Yeah, just to get back to what Eveline's talking about, I don't know if anyone remembers it. In 1995, there was supposed to be the peace dividend. NATO was going away, and Russia was continuing to grow economically around the world. We were all friends. Anyway, keep on going. Okay, Mauro, remember the piece dividend?
Well, it was interesting when you said that there may be countries ready or that they would like to issue a currency backed by a commodity. Actually, there is one country that already did that and did it in a digital way, the Venezuela with the Petro.
Yeah.
Even if, as you probably know, the project failed because it was not really a decentralized coin. So the amount of Petro mined and issued was not really in line with the asset that was backing the Petro itself. But yeah, I really think that, I mean, I'm not completely sure that the US would be very happy about somebody that will try to substitute the dollar with something else. So it's an interesting way, but if nobody has really had any success on that, maybe there is a reason behind that.
Yeah, but more, you know, to me, the issue is the politicization of money, number one. And number two, that the financial system is inherently extractive for the average person. So, you know, we bailed out banks for $15 trillion worldwide in 2008, and we foreclosed on 6 million homes that was less than $3 trillion of value as a result of 2008. So how does the average guy get by? Anyway, listen, great job, Mark. Fantastic.